Have you ever wondered what actually happens to your money the moment you deposit it into your bank account? You probably picture it sitting safely in a vault, tagged with your name, waiting for you whenever you need it. Well, I'm here to tell you that the reality is far more complex, and frankly, a bit unsettling. The truth is, when you deposit your money, it doesn't stay in the bank. Think about it. The bank gives you a tiny interest rate, maybe 1 or 2% if you're lucky. But when you take out a loan, they charge you 5, 10, even 20%. How does that math work? How can they afford to pay for their massive buildings, their staff, and still make billions in profit? It's because they're not just holding your money, they're using it. Your hard-earned cash is the raw material for their business. This system has a name: fractional reserve banking. It sounds complicated, but the concept is surprisingly simple. For every dollar you deposit, the bank is legally allowed to lend out a significant portion of it. They only have to keep a small fractional reserve in hand. Imagine you deposit $1,000. The bank might keep just $100 and lend out the other $900. That $900 then gets deposited by someone else into another bank, which then keeps $90 and lends out $810. This process repeats, effectively creating new money out of thin air, all backed by your initial deposit. It's a legal art of multiplying your money for their profit. This leads to a shocking revelation, a fundamental shift in how you should view your relationship with your bank. You think you're a customer, but in this system, you're more like collateral. Your deposit isn't just a service you're paying for. It's the asset that allows the bank to generate massive loans and profits. You are the foundation of their entire business model. They aren't profiting from safely storing your savings. They're profiting from the trust you place in them, a trust that allows them to leverage your money many times over. Let's look at the numbers, because this isn't just a theory. It's a fact of our financial world. Historically, for every $1 deposited, banks could lend up to $10. The reserve requirements have changed over time, and in some cases, they've even been reduced to zero, meaning they could theoretically lend out every single penny you deposit. The entire system is built on a delicate balance of confidence. It works as long as we all don't ask for our money back at the same time. But what happens when that confidence wavers? We don't have to look far back for a stark reminder. The U.S. regional bank collapses in 2023 were a massive wake-up call. We saw long lines of people, worried sick, trying to withdraw their funds from institutions they believed were rock. These weren't small, obscure banks. They were significant players. It proved just how fragile our safe money really is. When a wave of withdrawals happens, a bank-run delusion shatters. The bank simply doesn't have everyone's money because it's been lent out. It's a stark reminder that the digital numbers in your account are more of a promise, an IOU, than physical cash sitting in a vault. So, if the system is designed this way, what can you do? Does this mean you should pull all your money out and hide it under your mattress? Not necessarily. The modern economy relies on this system, and for day-to-day transactions, banks are essential. But it does mean you should be smarter about how you store your wealth for the long term. The key is to understand the difference between currency and value. The dollars in your bank account are currency, a medium of exchange. True value, however, is something that holds its purchasing power over time, independent of any single system. This is why it's wise to consider keeping some of your wealth outside of the traditional banking system. This isn't about being a doomsday predator. It's about intelligent diversification. Think about assets that have historically been a store of value. This could include physical assets like gold or silver, real estate, or even certain digital assets that are decentralized and not controlled by any single entity. The goal isn't to abandon the system entirely, but to build your own personal financial fortress, one that isn't solely reliant on the promises of a single institution. By diversifying where you store your value, you're creating a buffer. If one part of your financial strategy faces a storm, the other parts can keep you stable. It's about taking control and reducing your dependency. It all boils down to a simple but powerful moral. You trust the bank with your money, but the bank trusts your ignorance of how the system truly works. Your financial education is your greatest asset. By understanding the rules of the game, you can start playing it to your advantage, not just as a pawn. You work too hard for your money to not understand what happens to it after you've earned it. Don't just be a depositor. Be an informed owner of your wealth. Start asking questions, do your own research, and build a financial future that is resilient and truly yours. Thank you so much for taking the time to explore this with me today. If you found this information eye-opening, please hit that like button and subscribe for more content that helps you master your money. I'd love to hear your thoughts in the comments below. Stay curious, stay informed, and I'll see you in the next video.